Welcome to the RLT Pivot Podcast, where each week we discuss a trading topic in a way that will provide encouragement, inspire growth, vanquish fears, offer solutions, and take you to the next level in your trading journey. So get ready as we dive in right now. And welcome to another Pivot Podcast. Thank you so much for joining us. My name is Tracy. I'm one of your co-hosts, and I am so happy to be joined once again with my amazing co-host, Mr. Dan Jensen. How are you, sir?
Doing good, Tracy. Appreciate it. Super excited for our guest today. We got incredible trader Chris Tate on the show, all the way from Australia. So, pleasure to have you here. Welcome.
Yeah, thanks for having me.
Yeah, absolutely. What's your background? How long have you been trading for? Did you come from a financial background? Is it something that you grew into?
Now you've asked a really good question, actually.
It's only a 30-minute show, too. So
that's a good question to kick off with. How long do we have? I don't have a financial background at all. I come from a very, very different background. My academic training is originally trained as an immunologist. So my gig is the human immune system, where it used to be. And if it were not for crappy pay, students, politics, applying for grants, and the fact that the life of a poor academic researcher did not suit me, I would still be there. And I started trading, I think there were still dinosaurs around, about 1983. I caught the first beginnings of the 1980s bull market. And what had happened was I'd been doing a little bit of, let's say, corporate sort of work for part of our boom here in the 80s in Australia was biotech companies, and I was doing a bit of consulting for them. And the interest just grew out of that. To me, it was a problem to be solved, and I like solving problems. And so here I am in the next century still doing the damn thing.
Oh, that's awesome. I love your story because I knew that you were an immunologist, and I think the transition from immunologist to trader is so very unique. And I guess one of my curiosities is, how does a guy like you transition from something so different and maintain his focus and learn it to a point that you've learned it?
I think one of the mistakes that people make when they come to trading of any sort, let's look at the entire spectrum, from investing to, managing your retirement fund to whatever, to very, very active short-term trading. One of the mistakes people make is that they're convinced that they need some sort of financial background. You need an MBA from Wharton, you need a degree in quantitative finance, you need to be an economist, which is all completely wrong. The only thing you need to be able to do, no, I won't say the only thing, I'll say the prime thing you need to be able to do is to look at things logically, simply, and without bias. One of the problems I had early on, because of my background, was I believed that problems could be solved by complexity. And actually, in the 80s, there was a thing that went through the academic spheres of complexity theory. This notion that the more data you throw at something, the more you can, the more you remove the opacity of the problem. And I think once people get over that hump and realize that trading is a paradox, the rules are really simple. You buy things that are going up, you sell things that are going down, you cut your losses. But the paradox is that for humans, that's actually very, very hard. And once you get over that, or you appreciate that, then I won't say it becomes easy, because it never becomes easy, but it becomes relatively frictionless. And a lot of the friction that you bring with it just disappears. And so once I'd worked that out, a lot of the baggage I brought with me disappeared, because trading is essentially very, very simple. It's not complex. I know people on the sell side, like brokers and financial advisors, want to convince you that it is, but that's they're talking their book. They do that because they want you to abrogate power to them. Once you abrogate power to them, you abrogate your money to them, which means they get wealthy and you don't. And so once you overcome that little paradox and understand the simplicity of it and work towards simplicity, the game becomes easier and it becomes a game.
Fair enough. Fair enough. Do you think that having that lack of, financial background, do you think that that helped maintain your biasness then? Or, sorry, your lack of biasness in the markets versus...
I think it does.
Okay.
Because you look at things through a different lens. You don't come with this notion of... Well, let me use the example of, let's say, value investors. Value investors approach things with a notion that, A, you can solve for value, which I don't think you can do. I think that's an impossibility. You solve for your perception of value, but you bring with you this bias of a narrative of what is good. A company is good if, whereas as traders, we approach that same equation with a notion that the company is only good or has value to me if, after I have bought it, it goes up. If it doesn't do that, it has no value. It's useless. Now, imagine the situation that you're a value investor and you come across cryptocurrencies and you go, none of my models work because they intrinsically have no value other than the value the market ascribes to them, because that's just the way speculative instruments work. And so whenever you have a background in something, you bring with this story, this narrative, and all these things you think to be true. And if you're an economist, you assume that markets are efficient. No, they're not. They're efficiently inefficient. Otherwise, people would not be able to make the money they do. You assume that people are logical. God, have you noticed the past 2 years and the way people have behaved in the pandemic? People aren't logical at all. I don't know what it was like in your neck of the woods, but here, the moment a lockdown was announced, all the toilet paper in the country disappeared. That's not logical behaviour. And so people bring that same sort of behavioural matrix to trading, and it's very difficult to get rid of.
I think we had the run on toilet paper too. So we had a global toilet paper crisis, I guess.
It was that was all our great failing. We all should have gone short airlines and long toilet paper. That's where the money was.
What is I guess how long did it take you to get comfortable in the market from your transition into, hey, I'm going to start trading, to I think I got a hang of this and really grab it by the reins?
The word comfortable is an interesting one, because I actually think that trading is perpetually uncomfortable. And I only say that because it's perpetually uncomfortable because we don't know what tomorrow brings. Humans are always unsettled when we don't know what the future is. That's just the nature of the way we are. We plan in a certain way, we act in a certain way. And so I think from my perspective, another way to say it would be that I got comfortable with the process. And that actually took several years. And they were very, very expensive years. And they were expensive because, coming from a sort of semi-quantitative background, I was naturally drawn to derivatives because, they had equations, you could solve equations. The equation gave you the right answer. Whether the right answer matched what the market was doing is a completely different story. So it took me some time to get comfortable with the process. And now, as you would expect, decades later, the process is seamless and frictionless. But there is still that little bit of discomfort every now and again when you open up the dealing system and you go, what? Oh, okay, here we go. That's a natural reaction for everybody who trades, I think. There will always be those moments. We used to have an expression on the dealing desk when I was a broker that sometimes it was impossible to buy a winning trade. And sometimes it is. And that's just part of that natural. I'm comfortable with the process, but I'm uncomfortable with the outcome at times and the environment I'm operating in.
Well, now, correct me if I'm wrong, but you are primarily a swing trader, is that correct?
Yeah, momentum/trend, yeah.
Okay. And from what I understand, you focus mostly on rule-based trading, and you try to keep it simple. Can you explain a little bit about that and how you kind of developed that system and how long it took you?
Let me use perhaps an analogy,
okay,
or a story. I paid my way through university by being a doorman, a bouncer. And one of the things I tend to do is observe other people's behaviour and people who can do things and who are better at things than I was. And so when I worked as a doorman, I'd come from contact sports. I competed in full contact martial arts tournaments, but bouncing is very different because there's an intense emotional component to it. And you're dealing with people who are either profoundly upset, somewhat deranged, or have taken every drug that you could ever possibly imagine. And I was chatting to one of the old bouncers there one night, and they said, okay, what's your process? Because I'm process driven. If you understand process, then you can do things. And he said, look, if it's all gone horribly wrong, if you can't disengage, if you can't de-escalate, just hit that and insert your own word there as to who they were. And I said, okay, that's cool. What happens if that doesn't work? He just goes, hit them again, but harder. Okay. Rules to live by. I don't know when I'll apply that, but that's handy. It is that simplicity of process that I like. One of the things we try and do in trading is that we think if we make it hard, it makes it easier. But trading, I think, is a subtractive process, not an additive one. And I often see this with new traders when we're sitting talking and I say, okay, tell me what your approach to the market is. Tell me how you see the market. And they'll open their laptop or their iPad and up will come this chart. And the chart will look like, well, you won't be able to see price to start with because it will be plastered with every conceivable indicator in the world. Because there is this belief that if one indicator makes you profitable, 20 makes you 20 times as profitable. And the thing they fail to realize is that all indicators are iterations of price. And each iteration takes you away from price. So every time you perform some sort of manipulation or calculation, you move one step from what price actually is telling you. And so my job is to try and make that as simple as possible. You'll see behind me, I've got a couch. If I'm uncertain as to what is happening with an instrument, I'll simply blow it up on this big curved monitor I have, walk to the back of the room, get a cup of tea, sit down, turn around and go, it's going up, I'm a buyer. I can't be anything else. I can't possibly have any other opinion. Or it's going down, so I'm either neutral and out or I'm short. I can't have any other opinion. Now, I can try and construct an opinion based upon my bias or my perceptions about what I perceive to know about the company, but I have to be a buyer. I can't be anything else. And the current example of this sort of interaction of reality and bias at present is with cryptocurrencies. And my view of cryptos is that it is in many ways this generation's .com boom, South Sea bubble, tulip boom, boom before 87. The technology of blockchain and cryptos are distinct. They're two different things. But irrespective of that, cryptos present an opportunity to make money. Why do they present that opportunity? Why? Because they're a speculative instrument that is trending up explosively. Leave everything else aside. So if I put up Bitcoin or one of the other coins on this monitor, go sit in the back of the room and look at it and go, well, it's trending up. I have to be a buyer. Yes, I can construct all these arguments about the fact that it will never replace the base currencies we have. It will never be a true store of value because it's too volatile. The technology is different. They're all irrelevant. The relevant thing is, well, the candle's green. I can't be anything else. And it is that simplicity, but it's very hard to get people to that point of simplicity. It's very hard to get them to accept that that is actually all you need to do. If you want to run a moving average, that's fine. If you find that that helps with the decision-making process, that's a good thing. But having 13 of them won't make the decision-making process 13 times better. You'll just sit there and become confused. And I'm a tremendous believer in simplicity. Make it as simple as possible and then make it simpler.
In your opinion, is there such a thing as a bad trader?
Oh, hell yeah.
What would cause somebody to be a bad trader? What is some of the attributes that you would put on what you would call a bad trader?
Look, I could be facetious and say that everybody who manages money professionally for other people is a bad trader because they all underperform the market. In your country, managing 401ks, all underperform the market. Here in my country, people who manage superannuation, our retirement schemes, all underperform the market. I think there's a variety of reasons. There's some that are technical. They just don't know what they're doing. They just do not understand how markets work. And I would apply that to professional money managers. I've met a lot whose knowledge of markets and how they actually work is incredibly poor. But they're incredibly well remunerated for not knowing much and not providing any value, which has always intrigued me. I look at some of the salaries that are paid money managers here, and I think, well, in my day, I could have been twice as incompetent for half the money. And so there are technical reasons. They just don't know how they work. And it comes back to our early conversation. They bring with them biases. They have a degree in business. They have a degree in economics. So they think they know. The others are personality-based. One of the problems with trading is that we have a perception of ourselves, and we may consider that we are logical, precise, organised, disciplined, and a raft of very positive sort of annotations to our character. But when confronted by the market, we find out that we're illogical, ill-disciplined. We're actually frightened a lot of the time, and we simply can't do it. From my perspective, the main defining points run along that fault line of personality. Trading is a psychological endeavour. Irrespective of what anyone says, at its heart, it is psychological in basis. And it is psychological because you have to make a decision to buy something. You then have to manage your own emotions during that trade to continue to hold that thing, to continue to be there. One of the most any idiot can buy any instrument. That's really easy. It's profoundly simple now. You just pick up your mobile phone, push a few buttons, and you bought something, often in an obscure exchange overseas. But it is that, what do I do now? Then I bought it and it's gone down. What do I do? Do I admit that I am wrong, which is profoundly difficult for people, and kill the position, move on, start again? But we also have the other issue of what happens when I bought it. Let's say I bought it at 1 and it's gone to 2. What do I do now? And that presents just as much of a problem for people as positions that run against them. Because unfortunately, whilst trading is simple, where we say, you just cut your losses, let your profits run, people are engineered to do the reverse. And overcoming that base engineering is incredibly hard. It's so difficult for people. The number of times traders have this remarkable ability of snatching defeat from the jaws of victory. They will just be on the cusp of sending the account to a new level, and they will do something stupid. And they'll do something stupid deliberately. And they'll do it because they're uncomfortable with success, they're uncomfortable with their relationship with money, they're uncomfortable with the notion that doing things that will change them will change their environment. It will move them from the people they knew. They'll move to a different suburb. They'll live a different lifestyle. And so their subconscious just collapses in around them, and they engage in all sorts of stupid behaviours. So the defining point is simply what goes on between your ears. It's how you think.
Yeah, I agree with you 100%. And I love the fact that you keep things simple. I love the idea that you step back and take a more of a macro look at what's going on, and it gives you an instantaneous, instinctual opinion of what's going on that you can act on. That being said, that's how to keep it simple for entry. How do you actually keep it simple for what you were just talking about, which is risk management?
Exactly the same thing. But one of the great mistakes I sort of had 1,000 years ago was I bought a copy of a book by Ralph Vince, who you may or may not have heard of. a sort of semi-self-taught mathematician, and he wrote a book on the mathematics of money management. My quantitative skills are pretty good. And I looked at it and went, what are you on about? Well, seriously, mate, I don't want to be rude, but it's not really making a lot of sense. Money management at its heart is based upon two precepts. One, don't do all you dough. Now, if you have a carefully defined risk limit of, let's say, 0.5 or 1% of the account, in a random entry system, it would probably take you the age of the universe to run into a series of losses that would devastate the account. It's almost, look, you never want to use the word impossible, but let's say it's functionally improbable that will occur. That takes care of itself. If I simply say to myself, on each trade, I will risk, let's say 1%, it's an easy number to deal with, of the account. I will position size according to that. When it goes wrong, hits my stop, I'm out, I've lost 1%. That's easy to recover from, both financially and emotionally. The flip side of that is I'm risking 1% of the account. When the trade moves in my favour, and I will have a defined series of benchmarks as to how far it's moved, I will move to risk on and I'll add to the trade. And I think one of the traders go through a series of evolutionary steps. If they survive the initial step of making their entry simple, what they then attempt to do is make their exits really complex. And that's not how it works. Let me use another story. I'm a bit of an aviation buff, and I came across an article a very, very long time ago. An aviation journalist came up with this wonderful scam. He was a trained commercial pilot, as they tend to be, because it's their passion. And he wrote to the Royal Air Force and said, look, I'd like to do a feature piece on your fast jet training. Can you put me through it? And they went, yes. And he went, God, I can't believe they fell for that. And so he went through their fast jet training program. And he was out on a training mission, flying through the hills of Wales. And during the briefing, he was in the back seat because still trainee. And the pilot in front of him said, look, we're going to go here. The waypoint is here. I will turn here. We will do this. You will have command of the aircraft from here. But he said, if anything goes wrong, I will call eject, eject, eject. Please don't expect to hear the third eject because I'll be gone. This is the notion of stops. Stops are designed to prevent you killing the account, but they're hard to enact. They're very, very difficult for us to do. Again, we come back to psychology. It's hard to lose money. It's hard to make money. This is the terrible paradox of trading. But it's all very, very simple because the market will tell you when it's gone wrong. Now, you might be very, very good at pattern recognition. You might be very, very good at recognizing micro patterns where you recognize weakness in price action and you use that. You might be very robust and mechanical like me and say, well, look, my stop is a simple ATR plotted stop. Just runs behind price automatically. Get a touch, I'm out, we're done, I'll move on. And it is, again, we come back to, it doesn't have to be hard. I understand why you want to make it hard, but it doesn't have to be hard. And making it hard won't make you any more money. It'll actually make you less money. But again, we're back to the way people think. And that's the hard problem to solve.
Do you think a lot of the, not mistakes, but the greed or the inability to say, look, I'm wrong on this trade, or I've got profits, maybe I should lock them in. Does that in some way reflect greed on some traders or their attachment to money in a maybe sense that they should not be attached if trading?
Yeah, I think we all come to markets with a set of money scripts, with a set of feelings, beliefs, understandings about money. It might be, for example, one of the difficulties I had to overcome was I grew up with the precept that wealthy people were wealthy because they've cheated or stolen. And so that influences your relationship with money. That is a misstep for traders because that does act upon their psyche, their subconscious. And it is one of the reasons why they fail to get going. I've known people who technically and intellectually and emotionally really should be very good at this, but 2.5 decades later, they're no further along. And it's because they haven't solved that relationship with money. The point you make about greed is a very, very interesting one. And it is this, how do we, I'm trying to think of the right word or the right expression. How do you express your desire to get ahead, move ahead, change your lifestyle, do all these things without creating prickliness around you? Because the word greed has that negative connotation. People look at it, they associate it with, it's sort of, lump it in with the 7 deadly sins. And it's not something to aspire to. And so as an emotion, greed causes us all sorts of problems. And I do actually think, though, there are times to be, and it was George Soros who uses the expression, be a pig. There are times when the market is telling you to be a pig. The initial run, let's say in Bitcoin, was a time to be a pig. We've had runs this year in a lot of the agricultural commodities. They were time to be a pig. They were times to be hyper aggressive, to go after it. Now, many people would look at that and think, well, you really only need one car, don't you? Well, yeah, you only need one car, but you might want more than one. And when I have people who chip me about greed, my response to that is really quite simple. The best way to help the poor is to not be one of them. It's as simple as that. The only way I can do the things I do for other people is because I have more than I need. If I had less than I needed, I would be one of those people and be in need of assistance. But the point you make about greed is a powerful one, and it is a difficult issue for people to overcome.
Yeah, I agree. And I think that it's one of those words that people need to challenge. Just like you were saying with money, the relationship that you have with money, I think the same thing happens with words like greed. We really need to evaluate what we define as greed, because in my opinion, greed is simply another form of hoarding. So if you are hoarding and not freely giving your money, if money is just coming in and never going back out again, that to me is greed. And I think that it really comes down to people's perceptions of what those things are. So I think that's absolutely key.
And it's used in the pejorative. It's not used as a compliment.
Yeah.
But by the same token, would you say to someone who is, let's say, very, very keen on their own personal health and well-being, their own fitness, would you say to someone who eats really well, exercises every day, and has all these wonderful relationships around them, would you say to them, well, you're just being greedy about the amount of fitness or the amount of sort of emotional sustenance you can get from positive relationships? You would not say to them, you would not use the word greed as an insult. Whereas when you talk about money, because we have this, and it comes back to, I think, this strange Judeo-Christian relationship and sense of interaction with money that we've had for 2,000 years, that causes people problems. Yes, there are absolute psychopaths out there. You could cast a net over any of our current tech billionaires and note that they're complete and utter psychopaths who are greedy beyond belief and who do nothing to share the wealth they have or to do something positive with it other than sort of building rockets that look like, well, let's not talk about what the rockets they build actually look like. So they're clearly compensating for something in that respect. And so, yes, there are people like that. but I would suggest that a lot are not. And, the word greed is an insult.
Yeah, appreciate you coming on to the Pivot Podcast. Before we do a little send off, is there, in case somebody's listening wants to get in touch with you, what's the best way for them to reach out or find out more about you or your programs?
Best ways to reach out is simply come to tradinggame.com.au. You'll find me there.
Awesome. All right, guys. Well, Tracy, awesome co-hosting with you again. And for all you listeners out there, if you want to click into the links below, we will put a link to Chris Tate's site. Also, you can catch Real Life Trading on Twitter, Facebook, and you can check out reallifetrading.com for all of the free education and content. And we will see all you guys next week. Take it easy, guys.